In this video, I'm going to discuss my thoughts on the real estate market for this year, 2020, where we are and what I see coming in the future. I'll also be discussing the data around home sales, demand and inventory, as well as some economic data on how the pandemic has impacted the overall real estate market. Now, I recently made a video on buying a home during the pandemic, and I discussed the 30-33 rule, and I'll include a link to that video in the description. Now, one of my most active subscribers, one of my most active WhatJoe Polarizer, suggested I make a video about my thoughts on the real estate market, and here we are. By the way, guys, be sure to check out his channel. He has some awesome quality content and is very supportive of other small YouTube content creators. Well, guys, nobody has a crystal ball and can predict the future, but I did take the time, I mean hours, guys, to sort through tons of real estate and economic data for this year, and I'll be summarizing, sharing my findings with you guys. I've analyzed the data and come up with my own opinions, and remember, Joe, it's just that. It's my opinion based on my interpretation of the data. With that being said, guys, again, my goal is to add value and try to strike a balance between giving you enough information and not boring you guys to death. By the way, if you guys enjoy the content, please be sure to hit that like button and share it with others on social media. It goes a very long way in helping to support and grow the channel. Alright, so if we rewind back to the beginning of 2020, pre-pandemic, there were concerns among real estate investors about the housing market and how it would perform this year. These concerns were driven by changes to the Federal Reserve monetary policy, a decline in the stock market, a surplus of available jobs, record all-low unemployment rates, high consumer debt, and not enough affordable housing to accommodate a huge millennial population that is looking to enter the real estate market as first-time home buyers. However, now that we are through the majority of 2020 and dealing with the impacts of the virus pandemic, most of these predictions for the year have been just thrown out of the window. I mean, it's just completely null and void. No one saw a huge economic meltdown driven by a healthcare crisis that has not been maintained. Fast forward to today, we are now dealing with all-time unemployment rate, major business foreclosures, a healthcare crisis, an unstable stock market, and an economy in recession. Not surprisingly, we saw a big drop in real estate activity immediately following the virus pandemic outbreak. However, what we have seen is that in the last several months, home sales have rebounded. There's still high demand for affordable real estate in growing markets. So guys, buying activity slowed down due to the pandemic but has significantly rebounded. The pace with which other buyers are willing to make offers and a desire to lock in record low interest rates are driving the buyer demand. Growth in housing demand, asking prices, and sales have all recovered in the last several months, but new listings remain the missing link. With that being said, Joe, I would say that one of the most pressing issues surrounding real estate in general right now is the lack of housing available to buy. So essentially, guys, we have more people wanting to buy than available inventory, and this, coupled with a low interest rate environment, is driving the cost of real estate upward and making the real estate market more competitive than ever. While the virus pandemic has impacted every person and industry on this entire planet, the housing market overall has fared relatively well compared to other industries. Again, while home sales are trending back up, a huge lack of new and existing homes for sale continues to be a roadblock for many new buyers. Record low mortgage rates, a shortage of inventory has kept the U.S. housing market strong with respect to buyer demand. Even though it is late in the year, we are experiencing unusually high buyer demand. Buyers are moving much more faster this time of year to beat out competition and lock in those low mortgage rates. The national median listing price on Realtor.com was $350,000, which is up 10.1% year over year, while prices rose 8.9% in larger markets. While prices are making sellers more happy, the buyers are worried as prices rose during the lockdown and could even rise further due to heavy buyer competition and a significant shortage of supply. So supply has been very low and demand is very high. We know that this combination drives up housing prices. In 2020, there are 22% fewer starter homes. At the same time, our population is growing. Millennials are now the largest population in the United States and are forming households and looking to buy houses. In terms of U.S. population growth, between 2006 and 2016, there were 24 million new Americans. The population of the United States has grown since the last recession by over 25 million people. Despite massive job growth, our workforce is actually shrinking and the US birth rate is at a 30-year low. So we have a growing millennial population that is entering the workforce and forming households. There's even a greater number of baby boomers that are retiring. All of these factors have an impact on the overall real estate market. In just the second quarter of 2020 alone, housing demand went from being down 41% to up 40% year over year. If you think about that, Joe, that is a quick and huge bounce in the housing market. Again, guys, it appears that the low mortgage rate, population growth, and an increase in buyer interest are further driving demands for available housing. When we look at the current economic data and compare that to what some economists had forecasted for the first quarter of 2020, which was that housing prices would fall in 2020, we can see that those predictions appear to be wrong. Now, my personal interpretation of the housing and economic data is that it took nearly 5 months for sellers to make a return to the housing market due to the virus pandemic. On the supply side, it is interesting to see that the housing market where new supply is improving the fastest tend to be higher priced areas than those that have yet recovered. This suggests that sellers are returning faster to the more expensive housing markets like Seattle, San Jose, Los Angeles, and San Francisco. New listings and total inventory are down overall. Sellers are quickly putting offers on homes that come up for sale, which is driving up the overall number of homes for sale lower. That continues to put a dent on overall inventory volume. Now, time on the market is still 12 days faster than last year. This means that homes are sitting on the market for much less time despite notably higher price tags. Now, as far as future home sales for the fall and winter, we could see another dip in sales if the US is hit with a second wave of the virus and we see a rise in infection cases, as some experts have warned. So the big question of the day, guys, is are we in a housing bubble? Are we in a housing bubble, and is the market going to crash in 2020, 2021? Now, no expert out there can give you a 100% guarantee on what the future holds. I mean, after all, the virus pandemic hit, which was unexpected. Much of the forecast for the year went out of the window. But let's dive into some more data and we can try to come up with the answers to the question at hand. With 10 years now passed since the Great Recession, the US has been on the longest period of continued economic expansion on record. And the housing market has been along for much of that ride and continues to benefit greatly from the overall health of the economy. The housing market before the pandemic was remarkably strong. However, due to the spread of the virus, the federal government ordered a de facto shutdown of the entire private economy, closing an estimated 80% of businesses. This has caused unemployment to soar to at least 10%, while tens of millions of Americans are stuck in limbo, not knowing what's going to happen with their jobs. When the pandemic hit, the government issued the CARES Act, which put moratoriums on federally subsidized mortgages, allowing borrowers to put off payments without penalty. This has worked as a short-term solution, but with the virus spreading across most of America, homeowners may be wondering if any long-term assistance is coming. Homeowners that aren't able to gain employment after losing their jobs may find it tough to make their mortgage payment when forbearance runs out, especially if Congress does not renew the enhanced unemployment benefits that paid $600 per week under the CARES Act. The good news, guys, is that the government controls 61% of mortgages through Fannie Mae and Freddie Mac. Because these are government-backed mortgages and their lending standards are higher, they do present less risk. High-risk mortgages are also not around as much as they were during the Great Recession of 2008. Delinquency rates on mortgages were at a 20-year low earlier this year. When the pandemic hit and millions of people lost their jobs, our sense of normalcy, normal life changed dramatically. I don't expect foreclosures to reach levels anywhere near what we saw in the Great Recession of 2008, but there will likely be an influx of homeowners that will default on their mortgages and be forced into foreclosure. Now, some positive economic data is that the national median existing single-family home price in the first quarter of 2020 was $274,600, which is up 7.7% from the first quarter of 2019. Now, housing market data is indicating that the market is beginning to heat up again as more sellers and buyers enter the market. Before the virus pandemic, Realtor.com's national housing forecast was that home price growth would flatten with an expected increase of 0.8%. Now, inventory was predicted to remain limited, especially for entry-level homes. Mortgage rates were predicted to likely bump up to 3.8% by the end of the year. Now, tight inventory coupled with rising mortgage rates would have led to dropping sales. Buyers were expected to continue to move to more affordable markets, which would have benefited small and mid-sized markets. Another important factor we need to keep our eye on, and is not discussed as much, is the declining purchasing power of the dollar. So with trillions of dollars being spent in the CARES Act, and likely again if we pass a second stimulus package in the near future, all of this influx of money into our economy, although it's needed given our current circumstances, will have an adverse impact on the US dollar. Government stimulus checks, extra unemployment income, and money for businesses are all contributing to a decrease in the dollar's value. What's important to remember is most of this borrowed money has to eventually be paid back. As such, we're seeing asset values and home price increases as the dollar declines in value. In other words, guys, real estate investors win because the value of home equity in the United States keeps going up with inflation. So if you are an individual out there with a low fixed rate mortgage, you should continue to build equity fast as inflation eats away at your debt. In a research report in which Zillow surveyed 100 real estate experts and economists about their predictions of the housing market, it found that almost 50% of all survey respondents said the following recession will initiate in 2020. The main culprit for the housing recession is monetary policy. Experts predicted that monetary policy will be the deciding factor this time around, and particularly they argued that the Federal Reserve could prompt slower growth if it raises short-term interest rates too quickly. To break that down even further, Joe, the U.S. housing market, to me, is still very ripe for investment, making it a great time to buy a rental property for sale to increase your cash flow. We now have a multi-generational housing market that has created limited supply and increased competition, which again has driven up prices at the affordable end of the market for the foreseeable future. Some of the hottest job markets and communities for our younger generation, particularly those working in tech, engineering, and healthcare, are forecasted to see price increases of 8 to 15% year over year. For everyone else, real estate is appreciating at or above the rate of inflation, which was one of the main reasons I personally love real estate. It's a great hedge against inflation. The home price appreciation rate has slowed so far, but prices are still going up. They're still rising. Now, many economists predict that home prices will continue to rise, and much of that will depend on our economy's ability to bounce back from this pandemic. With that being said, guys, this virus pandemic has taught us that things can change in an instant, and it's almost impossible to make 100% accurate predictions on anything. At looking at the data as well as past and current trends, I anticipate mortgage rates will remain low for the rest of 2020 and throughout 2021. Now, if we are hit with a second wave of the virus and there's additional damage to our economy or additional shutdowns, I anticipate a continuing housing shortage. If and when we're able to get this virus pandemic under control and businesses begin to reopen and jobs return to the economy, I would anticipate a continuation in housing demand, but I think that the housing supply will also increase to meet that need. Now, if we do in fact see an increase in housing inventory, this may make the real estate market more equitable for buyers and sellers, in which case we could see a reduction in home appreciation and a slight pullback in property values. All right, guys, so that is my real estate analysis for this year and the upcoming year. Again, I just went through all types of data from different resources, and these are my opinions. Like I said, no one has a magic crystal ball and can guarantee anything. I really hope you guys found value in this video. If you did, please be sure to hit that like button and share it with others on social media. It goes a very long way in helping to support and grow the channel. Don't forget to subscribe and turn on that notification bell, as I'm posting valuable new information at least twice a week. Thanks again for watching, and until next time.